So let's get started. I think this is a great panel because this is a sector that, a lot of us don't give as much importance to as retail investors. And it's very important to me because I feel like insurance, life, general are cornerstones of your personal finance journey. So today what we're going to do is we're going to start where Mr. Ajay said left off, which is why is India still such an under-penetrated market? Mr. Kamlesh, let me start with you. And we've had this discussion, a lot of times in the past as well, as to how a lot of work needs to be done perhaps for the penetration in the industry to increase. But before I open the floor and I put up the poll in front of everyone, I just wanted you to set the context. India, as of now, is a severely under-penetrated market when it comes to insurance compared to the rest of the globe. Right, 2.7% of GDP, the global average is much higher. What do you think are the one or two things that need work on at this point in time?
I just borrow what Mr. Seth said, that I think there's work cut out for the council that we have created. We learned from the mutual fund campaign of Sahi Hai. I am saying we've grown to see that. And I think the fact that IC will now work with the industry together to make sure, like you said, accessibility is extremely important, availability is extremely important. Awareness does not seem to be an issue of life insurance, but like I said, the consideration to conversion to be able to buy is extremely important at this point of time. And therefore, under the aegis of LIC, SBI and the entire Life Insurance Council, we are at least now sure that we are going to do this on an every year basis for about 3 to 5 years continuously. Keep looking at what we need to sort. We finished the first campaign. We know what we want to sort. And like the chairman said, trust and complexity is what the next campaign will try and solve. We'll pick up real life examples, real life issues of life insurance. But the focus, like Mr. Doraiswamy always tells us, has to be in the tier 3, tier 4 and tier 5 towns, because we seem to be doing pretty okay in metro and tier 1. So combination of this is what is going to be the big focus, and we are committed, like I said, as an industry to make sure by 2047, or like the chairman just now said, if we have to grow at 3.5 as compared to 2.5, hopefully we'll get there a little faster.
Okay, hopefully we'll get there a little faster, but the stats are, quite underwhelming if you look at it. Despite India being the 10th largest insurance market in the world, if you look at the life insurance density in India, it's still at just $72 per person per year, and the global average is $388. So there is a big gap, and that's why the council is assembled here to find out ways and means of how to close that gap. So Mr. Doraiswamy, I want to come to you, and thank you for being here with us on the panel. It's a pleasure having you here. Trust, mis-selling, these are words that are that have been associated with the industry for a very long time. Of course, a lot of work is being done now to undo those damages. But you tell us from your vantage point, what are the 2 or 3 things that have caused this severe under-penetration, and perhaps the work that is now being done by the council, which will sort of help the penetration increase, especially in tier 3 and tier 4 cities like Mr. Kamlesh was pointing out?
As he already mentioned, one is to expand, to be made available, to be available to the customer at every point that he can approach. The physical presence of officers and availability of the products and services through the contact points. So what do we make the process as well as the product availability to the customer? 1. 2, life insurance is not something, as the chairman put it very clearly, where you buy something and you get the benefit of it. It's for something which is perhaps may not happen during the term, or it may be on a long-term basis. So the most important thing is to develop the trust. So that's something which LIC and the insurance industry has been focusing to see that the customer's trust is won over. That's the most important thing. It has been, as you said, for some time when the products were sold without the customer getting fully convinced about it, and feels after the sale is over that something has been given to him which perhaps does not suit him or does not benefit him. the entire thing goes for a toss. And particularly, as Sir said, the experience of one person getting transmitted to many people puts people off. So that is something which we need to be working very closely. How do we build the trust? How do we ensure that every customer who has been onboarded gets what has been told to him? What has been told as the main product, as the benefit of the product is made available to him. And in case of difficulty during the period, also how we support him and ensure that he keeps his part of the contract on track. These are the most important activities. Making our products available, of course, affordable, and ensure that what has been told is delivered. That's the most important part.
Mr. Seth, I want you to come in on this because there is a common narrative that and a perception amongst a lot of people who talk about financial literacy, talk about personal finance, that clubbing both insurance and investment may not be the right approach, because on one hand, you may be getting subpar returns. On the other hand, you may not get enough insurance coverage. So to that narrative, what would your... Because see, here what we're trying to do is we're trying to clear a lot of misconceptions. We're trying to increase awareness so that people know exactly what they're getting into when they buy some of these products.
It is certainly possible for somebody to buy a pure protection product and look for a pure savings product. And today the risk-free return in the economy, which is the government securities, is of the order of about 6.5% to 7%. But not all people or most people will not be in a position to do that kind of a financial planning, to do two things separately. So what this industry offers, a combination of protection and savings, is the USP of this industry. Idea is how do we improve upon it. If the protection element is very small, then it is competing more like a savings product. If both are a strong feature, that will enhance for people buy into that product. So that is what the improvement has to be. Nobody else can provide that combination. No other financial sector can provide that. While doing so, one important aspect, trust we have been discussing this forenoon.
Yes.
Important aspect is a large number of our people of our country are self-employed. Their income stream is not certain. Suddenly they will find their income levels have gone down. If they lost a job, they may take another 6 months, 3 months, 1 year to get back to the job. First, penetration. Relevant for our country is coverage. How many unique lives are covered rather than so much of percentage of GDP is covered. Again, we have lost the people. Lost in the sense we have lost their mindset. We should talk about this area, out of this locality, out of a population of 50,000, 5,000 have got a unique lives covered. We need to get it to 5,000 to 10,000. That's what our metric should be. Again, instead of talking about $72, our per capita income is 2.5 lakh rupees per person, or meaning that per capita income. So $72, about 7,000 rupees is not insignificant. We have to talk about metrics with which, or the metrics with which we can connect with the people. Your income is so much. Can you spare 1%, 2%, 100 rupees a month, 500 rupees a month to buy a protection plan? That is a way to connect. Thank you.
Samir Bansal of PNB Metlife is also with us. Samir, there are of course not too many people in their 20s here, but for people who are in their 20s or in their 30s, what is the most compelling argument today for getting a term insurance product?
I think we should first look at our country and like Mr. Seth said, our country has about 2.5, 3 lakhs per capita income, and our savings rate is about 10 to 12%. So every Indian is putting aside 35,000 rupees, aside for financial services investment, and term insurance has to really compete with that for that 30,000 rupees or 25,000 rupees. And it's, the thought always comes is that I have a family support system. Do I need term insurance? If something happens to me, my family will be taken care of by my brother or my father or my somebody else. So that thought, I think, is always prevalent. The other thing is that what will I get in return from this? And I think Kamlesh had touched upon in his presentation that there are return of premium plans also. So if you take a term insurance plan today and nothing happens to you, the money actually comes back to you. So I think, in India, we need to really look at it from two aspects, affordability, and then the softer aspects of ecosystem, family system, etc. In terms of affordability, I can tell you, life insurance in India, the premiums are the cheapest among the top 10 global economies. If you compare the top 10 global economies per crore rupees of cover, India offers the cheapest term cover in terms of per dollar. But still, it's a question of affordability because the 30,000 rupees or 25,000 rupees is not enough to really find for it. I think we are doing a lot as an industry. We are looking at reducing our premiums even further by digitizing our underwriting, by cost optimization, by reducing the instances of fraud claims, which takes away a large chunk of our cost. We're doing all of that. And there are some others which, since the chairman is there, I'll take the liberty of putting it across. Things like, first of all, government has done a lot to take away the GST. That's improved the affordability. But then if you look at the components of term costing, there is a costing in terms of stamp duty. There's a costing in terms of solvency cost. And I think the government was very kind for PMJJYB or 2 lakh cover to take away some of these aspects of solvency was 50% or stamp duty was reduced, etc. I think for the retail term or up to probably that limit can go from 2 lakh to 25 lakh or 50 lakh. A lot of these 20 and 30-year-olds will probably start opting term insurance further. I mean, already cheap, but given the affordability part of India, it can probably can be made even cheaper.
Okay, it can be made cheaper, and once that is done, then you think the penetration of term insurance could be?
It's already good here, but larger India, yeah.
I think this is not, a target audience, right? But also there is an argument, and we have Rushabh Gandhi, MD and CEO of India First Life Insurance also. Rushabh, thank you for being with us on the panel. On term insurance itself, your thoughts, and for people who are in their 20s and 30s who have dependents, of course, it is a great product, but also for people who are, say, in their 40s and 50s and who don't have enough of a corpus, investment corpus, right? And who have dependents, how important is it? And from your lens, how can penetration increase?
Thank you so much, Sonia, for having me. I think, most of the responses that the co-panelists have given pretty much address whatever you've asked for. One very important thing which I wanted to kind of add, and while somebody did mention that, we have a fairly evolved audience, having insurance is not equivalent to having enough insurance, right? And one of the bigger problems that we have as India, as a country, is the amount of insurance that each individual actually has. In my mind, and that's why I'm going to address, this part first. Penetration is extremely important. But the right amount of insurance is equally important. And as a thumb rule, right, most people, ask us this question that how much insurance do I really need? And Chairman sir actually did mention about 10 times. In my mind, the amount of insurance anyone needs is pretty much equal to, if he's not there, will the standard of living for the family change or not change, right? And then you kind of are taking a punt on, what the interest rate will be and so on and so forth. So amongst the insurance practitioners, how we look at it is, you kind of put a multiple of about 10 times, 20 times, of your income. And in addition to that, again, it was mentioned, I think, by the chairman, there's something called liability insurance, right? Every individual has a liability, right? You'll have a home loan which is outstanding, you'll have a car loan which is outstanding.
Some debt, yeah.
Pretty much. So that needs to be covered. So I think insurance penetration in itself is an issue. We are addressing it as an industry. The amount of insurance each individual has is also an issue, and that is also something which I wanted to highlight.
Mr. Doraiswamy, come in on this, because, ULIPs, frankly, 10 years ago, this perception of it being costly was accurate, right? There were a lot of front-loaded charges in ULIPs. There was so much confusion about whether your money was getting entirely invested or not and what your returns would be. There were no major disclosures given. There was the lock-in periods. People didn't know about lock-in periods at that time. So what all has been done since then to kind of undo the damage? And now if you can give us the correct representation of a ULIP.
Typically, when you take a ULIP and you pay the premium gets divided into 3 areas. One is what is getting invested, which is what you have paid minus what charges are levied. The 2 charges that are taken, one is for the policy administration, and one, most importantly, is for the risk cover. So you have a mortality. What is the premium required, the money required to take the insurance cover? Unlike a mutual fund, a ULIP also combines insurance built into it, by which whatever you are targeting to achieve at the end by contributing regularly is protected from day one also. So you are building a life insurance into it. So the life insurance premium, the risk premium component is deducted from what you have paid. A small amount towards the expenses of management of running that scheme, and the rest goes into investments. As you said, before 2010, there was no regulation as to how much it can be charged, and the insurance companies did collect a huge amount of portion of the premium, sometimes running into 60 to 70% of the premium paid as the charges towards the insurance companies, and only around 30 to 40% was getting invested. Depending upon different schemes or different companies, it was varying. But the regulatory changes that were brought in 2010 made a world of difference. Now, the charges are capped. And the charges for the first 3 years and subsequent 3 years, subsequent years have been differentiated, and a maximum of only 3% can be charged as expenses in a ULIP currently for the first 3 years, which reduces to 2.25%. Okay, and also the fund management charge, which is not charged separately, but it's taken out of the fund management from the returns itself, is also capped. So today you have a regulatory atmosphere where the industry protects what is being contributed by the subscriber, by the policyholder, and what can be taken. And if you are looking at the way this has been growing, you will find over the entire term of the policy, if you look at it, the expenses that is charged to a ULIP will be even much lesser than what actually is done in a mutual fund. That's the current situation that we are looking at. So this notion that, as we also saw in the campaign, the voting now, that mutual funds are costlier than, ULIPs are costlier than mutual funds is no longer relevant, but that notion has to be dispelled, and that's where the awareness campaign has to happen. We need to know that there is a small portion which goes towards building the insurance. See, for instance, I start contributing, say 1 lakh per annum, and start a ULIP, and I expect to pay for 20 years, let us say. I am looking at a 20 lakh contribution from myself, and I expect it to grow to say, let us say 50 lakhs or 1 crore. I can build up that 1 crore or 50 lakhs as a term insurance in the part of the plan itself. I don't have to separately take a term insurance. So when I contribute that premium, whatever I'm setting aside as 1 lakh per annum, or say 7,000, 8,000 per month that I pay, a small portion of that premium is deducted, and on a monthly basis, though I pay yearly, the insurance company deducts only the premium required for 1 month at a time, and with that small premium, it also builds up the insurance that I've chosen. So if I take a 50 lakh insurance cover, and in case I'm not alive at the end of 2 years, the 50 lakhs plus the accumulated value of the money that I have contributed towards units, both of that get paid to my family. So that's the concept of insurance. And if you look at in the entire term of the plan, the ULIP will most likely be having a lesser cost taken than a mutual fund does.
Okay, that is very interesting, because I don't think too many people are aware of that. Mr. Seth, you want to come in on this, because you know the reforms on ULIPs started post 2010. Lot of work has been done. As Mr. Doraiswamy was saying, charges are capped, expenses are now much less. But do you think that awareness about this has reached the right audience? And if not, where are we at right now in terms of awareness on ULIPs, and how much more needs to be done?
In terms of what unique proposition insurance industry can offer, this certainly is a product which requires a lot more attention, and IAC has its job cut out. Next to term insurance, ULIP is the most potent product to serve the need. Having said so, comparing ULIP product with a mutual fund would be akin to comparing Ratnagiri Alfonsos with Nagpur oranges. These are two different fruits. But even if we try to compare, I tend to, maybe educated, look at the numbers once again. Cost of ULIP and returns are somewhat higher than what it would be on a like-to-like basis. Even if we take out the component of insurance part, out of 1 lakh rupees, maybe 5,000, 10,000 has gone towards pure protection, the rest has gone towards the savings pool. Compare that savings pools versus what the mutual fund has provided for. That, even if that is not true, that is how the public perceives into this. We do not communicate it in that matter on a like-to-like basis. Second aspect which comes in, what the returns are, the way mutual funds declare that NAV on a daily basis available freely, we do not make that kind of an education part in a similar manner. So while we should not be defending ourselves, but we have to be more clear in positioning that product in the right perspective. And these are the two elements which can help us in taking this. And if you can say that initial 4, 5, 6 years, 7 years, ULIP, there was a huge offtake. Off late, that seems to be the growth seems to be sort of tapering, or it is coming down somewhat. So is a perception battle as well, and some introspection on our part that the expenses which were justified on a pre-digital India era, are those expenses are still justified, or there is a scope for shaving it off few basis points, and that itself can have this, that's a big moment to catch the attention once again.
So, large part of the audience, being people who track the sector so closely, don't have a retirement plan in place. Kamlesh, are you surprised?
Yeah, like I said, when I went to that meeting also, I was very surprised because, I think let's look at it mathematically. If you're going to live till 85, I mean, if you live till 60, I think these days they say you'll live till 85, for sure. So you have something called a working life period, which is between 25 and 60. So that's about 35 years. Which means if you live till 85, between 60 and 85 is another 25. It's very close to your working life where you had income. You're going to live another 25 years where there is no income because you don't work, say, beyond 60 in this country today. So that's the first issue. Second, of course, is the fact that, we used to have a traditional pension system in this country much before, which used to be our joint family. Yeah, we don't have joint family. I think my dad was much more surer that I would take care of him. If you ask me whether I'm sure whether my son will take care of me, I'd be at 50%. But if you ask my son when he becomes whether his kid will take care of him, I think by that time the answer will be 0%. Yeah? So the traditional pension system of the country is also going away because there's nothing called joint family any longer.
Also, I think in your age category, you would be taking care of your dad and of your son simultaneously.
Which is true, yeah. And then look at health inflation, yeah. I mean, between 60 and 85, I'm saying whatever numbers if they are true, health inflation is going to be at about 10 to 14%. So you combine all this together and say 25 years of that living, does it have annuity cover? I've been on the banking side and I keep saying that wealth is not equivalent to stream of income. And of course, I've had debates with Sonia on a separate platform on this. To say a continuous stream of income for that period of time is something that only annuity provides. You have a product from life insurance which says if you plan, you will get annuity for life. It doesn't have a period. We are not saying you'll get it for 10 or 15 or 20 or 30 years. We are saying as long as you live, we will provide that annuity. Large part of that is guaranteed, like Mr. Doraiswamy said, so you exactly know what is the annuity that you can make. The regulator has been kind at this point of time to bring in a new product which is called variable annuity, where you can have 60% which is guaranteed and 40% which can be linked to an index. It just got approved in March. So now you can have inflation-based annuity returns because if 40% is going to be in equity for, say, between 50 and 60, I mean, 10-year Nifty returns, you track, I don't need to tell you, will be significantly upwards of 11 and 12%, which can make annuity returns more significantly better. Now, that's the providing of a product which I think life insurance does. For the entire industry, that number is growing over the last few years. India is not going to be as younger as it used to be 20 years from now. I'm told that 50-year plus is going to double from where we are at this point in time. So I think the integral part of a very good product like annuity, I think life insurance does. And we've done a lot of work. We had one category when we did the first campaign and that was the one that hit the audiences the highest. And if you see industry numbers, by and large for everybody, what used to be about 2-3% of our business has already become about 10. I hear a lot of insurance companies talk about this becoming 15 or 20. I think the product, and we will build awareness in this area to make sure that it becomes an integral part of what we offer. But I think it's a great product that is offered. It's a large part of the insurance business outside India. And we genuinely think the companies put together as well as ISC will focus on making sure that that growth rate will be commendable over the next few years to come.
Okay, that's amazing. And also we are here to increase awareness about annuity products. So Mr. Doraiswamy, for someone who is planning their retirement, I mean, most people here don't have a retirement plan in place. What would your advice be to them? What should the approach be towards annuity products? How much of it should be towards annuity products? How much of it should be, you know, towards, say, equity, pure play equity products? How does one structure it now?
See, as Kamlesh put it, the most important thing when you are reaching the age of superannuation or when you technically reach a senior citizen stage is to have a peace of mind. Wealth can be deployed into many other ways, in many ways. But what we require is that we have that comfort that there will be a regular income hitting your bank account or your on the first of every month as long as I am alive. Suppose I have a certain sum of money, let us say. On the date of my retirement, I have some 1 crore or 50 lakhs. I'll take a small example of 50 lakhs. I deploy it in an annuity for life at current rates. Sir mentioned about risk-free rates or whatever it is. I'll be getting around at least 27 to 30,000 rupees per month, which is guaranteed for life. I put this, as you said, in equities, and I start withdrawing. And as a market tapers, this can be withdrawn at say same 6.5-7% for a period of 20 to 22 years, when my money will get completely withdrawn. Suppose I outlive that date. There has to be something that will still be protecting me. So naturally, when you are looking at utilizing your retirement corpus, there has to be a cushion of a regular guaranteed income for life. That's more important. It is not 5 years, 10 years, 20 years. Who knows, I may be 90 years. I may live up to 90. I may outlive beyond 90 also. So the question is, the risk of outliving your savings is one which is more pronounced in old age than having the risk of dying too soon. The risk of dying too soon is at the younger ages. So when you reach that age of 60 or above, when you stop actively getting engaged into an employment activity and earn, you need to have a regular guaranteed income. So when you are building up your retirement savings, you need to have a certain portion of your income, I'll say 1/3 at least, deployed in a regular income giving product, which is a life annuity, and the balance can be in other investments, maybe FDs, maybe mutual funds, or maybe direct equity, whatever it is. It can be the rest, but this is the floor on which the entire edifice of retirement planning has to be built.
But what is the argument against putting that money, instead of putting it in an annuity product? Since you mentioned that 1/3 should be put there, a lot of people believe that putting the entire corpus in, say, mutual funds would give you inflation-beating returns when compounded over 10, 15 years. What is the argument?
You can put that, but only, as I told you, the wealth grows and you start withdrawing. There has to be something which gives you guarantee, that gives you the peace of mind.
Correct.
In fact, one of my friends was even telling, even if you were to go and borrow from your neighbor, the neighbor will be comfortable lending it to you if he has the confidence that come first of next month, he has something to get from which he'll repay.
Okay.
That is something. So assured monthly income or a regular periodic income gives you the most important protection that is required. That is one. Two, there has to be a component of illiquidity in this kind of a savings. In fact, I even have an example. of a person who retired, and his son was just setting up a factory, and he said, Papa, you have retired. I would like to use your retirement corpus. I'm getting my adjacent industrial unit coming up for sale. I would like to buy that expand. And he gave the entire money. And when the next birthday of his grandson came, and the grandson came to the grandpa and asked him, can you give me a bicycle for this birthday? He had to go and ask his son whether he can take that money to buy. And father, as expected, said, no, he does not require a cycle, don't worry about it. Now the grandpa feels absolutely uncomfortable. So there has to be a regular income on which you can depend. That's very, very important. As I said, you need to keep it away from other temptations of investing or losing the money. That's most important. So though, that's why I said it need not be 100% into annuity.
1/3.
It has to be a certain portion, depending upon what kind of lifestyle you have and what kind of wealth to fall back on. You have to have earmarks under annuity.
Okay, well, on that note, we've run out of time, not out of questions, but thank you, gentlemen, for joining us and, bringing a lot of awareness across different facets of the insurance industry. And hopefully the next time we all meet or we talk here at this panel, the penetration will be much, much higher based on all the good work that the council is doing. Thank you so much for being here.